Confident Investing. A Beginner's Guide to the Stock Market. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. Have you ever thought about how the stock market could unlock your path to financial freedom? Imagine entering a world where deciphering symbols, numbers, and trends could lead to potential prosperity. It may seem overwhelming at first, like learning a new language. But what if I told you that with the right guidance, the stock market is not only accessible but can also serve as the foundation for your financial independence? Welcome to Confident Investing. A Beginner's Guide to the Stock Market. This book is specifically designed for individuals like yourself who may feel daunted by the concept of investing or perplexed by the financial terminology that often obscures the fundamentals of what should be an easily approachable endeavor. We aim to demystify the stock market, eliminate barriers to entry, and introduce you to a realm where your money works for you, not the other way around. This journey will not only be about learning how to invest, it will also transform your approach to personal finance. We will start by explaining the stock market and how it operates. From there, you will learn to make informed decisions, manage risks, and construct a robust investment portfolio tailored to your financial aspirations. Why should you invest in the stock market? Because it is one of the most effective tools available to grow your wealth over time. Whether you are saving for retirement, aiming to finance your children's education, or seeking to enhance your financial security, the stock market offers a platform where your money can experience significant appreciation. Are you prepared to seize control of your financial destiny? Let's embark on this transformative journey together, where we will unravel complexity and turn your uncertainty into a confident investment strategy. Join me as we delve into the fundamentals of stock market investing, designed to empower and enlighten. Subscribing to our channel will allow you to join our vibrant community of seekers and learners. Each subscription serves as a token of encouragement, fueling our ability to provide you with more captivating and thought-provoking content. Subscribe now, leave a comment, and hit that like button. Be a part of the movement shaping the future of learning and growth. In the comments section, please let us know what kind of books you would like to read, as your feedback helps us tailor our content to serve you better. I have posed several questions for you throughout the book. Take a moment to answer the ones that apply to your situation in the comments below. Chapter 1. Understanding the stock market. What does the term stock market mean to the average person? When you think of the stock market, you might imagine busy traders, screens displaying changing numbers, and news about market crashes and all-time highs. However, at its core, the stock market is simply a public place where shares of companies are bought and sold, pieces of businesses that you, as an individual, can own. Think about your favorite coffee shop offering customers the chance to buy a part of its business. By purchasing a share, you would own a portion of the coffee shop's future profits and risks. The stock market operates on this same idea, but on a much larger scale, involving thousands of companies and millions of investors. Shares represent ownership in a company's assets and earnings. As you acquire more shares, your stake in the company increases. When you invest in a stock, you have high hopes for the company's long-term growth and success, which in turn boosts the value of your shares. This allows you to sell them later at a profit. The stock market is divided into different segments. Primary market. This is where new stocks and securities are issued and sold for the first time through initial public offerings, IPOs. The market, where investors trade existing shares without involving the issuing companies, is known as the secondary market. This difference is important because it determines how you will engage with the market. Most investors participate in the secondary market, which is commonly referred to as the stock market. Stock markets play a vital role in the global economy. They enable companies to raise funds for expansion, innovation, and job creation. Simultaneously, they offer individuals and organizations the chance to invest in these companies and potentially reap the benefits of their success. But how does one get started in this market? Is it as straightforward as purchasing a share of your favorite coffee shop? Chapter 2 will walk you through the initial steps in the market, guiding opening a brokerage account, understanding various types of stock orders, and confidently embarking on your investment journey. Chapter 2. Starting your stock market investment journey. Ready to dive into investing but not sure where to start? Embarking on your first steps in the stock market may seem daunting, but fear not. With the right guidance and tools, you'll realize that getting started is easier than you think. This chapter will walk you through the initial steps you need to take to kickstart your stock market investment journey. The first thing you need to do is open a brokerage account. Think of it as your entryway into the world of stock markets. It allows you to trade stocks and other securities using a platform provided by a brokerage firm. Here's what you should keep in mind. Choosing a broker. Various brokerage firms are available, each offering different services, fees, and user interfaces. Some are beginner-friendly with educational resources, while others cater to more experienced investors with advanced tools. Types of accounts. You can open a standard brokerage account or explore other options, such as IRAs for retirement savings or custodial accounts for minors. Setting up your account. Opening an account typically involves filling out an application with your financial details, investment background, and risk tolerance. This information helps the broker provide you with suitable services while complying with regulations. Once your account is set up, it's essential to familiarize yourself with the different types of orders you can place. 1. Market orders. These orders allow you to buy or sell a stock immediately at the current market price. They are quick and ensure that your order is executed promptly. However, the final price may vary slightly due to market conditions. 2. Limit orders. With limit orders, you can specify the price at which you want to buy or sell a stock. The order will only be executed if the stock reaches that particular price. This gives you more control over the cost, but remember that there's no guarantee the order will be filled if the price doesn't match. 3. Stop orders. Stop orders can be useful in managing risk. You can set a sell order lower than the current market price to limit potential losses, or a buy order above the market price to take advantage of rising stocks. Understanding and effectively utilizing these different orders will empower you to trade confidently. However, deciding where to invest your money is another challenge. Chapter 3 will delve into the fundamentals of stock analysis, helping you make informed choices and pick winning stocks. Chapter 3. Choosing winning stocks. When selecting stocks that will increase in value, it's essential to go beyond mere speculation. Careful analysis and consideration of various factors are necessary to achieve your financial objectives in the stock market. There are two primary approaches to stock analysis: fundamental and technical analysis. Here's a quick overview of each. Fundamental analysis. This method involves assessing a company's financial stability, competitive advantages, market position, and economic environment. You can determine if a stock is undervalued or overvalued by examining earnings, revenue growth, debt levels, and management efficiency. Fundamental analysis aims to pinpoint companies with solid growth potential trading below their intrinsic value. Technical analysis. In contrast to fundamental analysis, technical analysis focuses on patterns in stock price movements and trading volumes to forecast future trends. This approach assumes that all available information is already factored into the stock price, aiming to identify trends and patterns that indicate future movements. Technical analysts often rely on various charts and indicators to inform their predictions. Both methods have advantages, and many investors combine the two for a more comprehensive decision-making process. In addition to analyzing techniques, it is important to consider your own investment goals and risk tolerance when choosing the right stocks. Do you prefer stocks that provide a steady income through dividends, or are you more interested in stocks with the potential for substantial growth? Understanding your financial goals and the amount of risk you are comfortable with is crucial. Now that you have learned how to evaluate stocks, the next step is effectively managing your investments to protect yourself from unexpected market downturns. Chapter 4 will explore risk management techniques that can help you safeguard your investments against significant losses. These strategies include diversification and setting stop-loss orders. Chapter 4. Managing risk in investing. Protecting yourself from significant losses is crucial when investing in the stock market. Although there are potential rewards, there are also inherent risks. Effective risk management is essential to ensure the durability and growth of your portfolio. In this chapter, we will explore various strategies that can help you manage and mitigate risk, giving you the confidence to pursue your investment goals. Diversification. Diversification is a fundamental and highly effective strategy for managing investment risk. By spreading your investments across different asset classes, industries, and geographic regions, you minimize the impact of a single investment's failure on your overall portfolio. This way, you don't have all your eggs in one basket. Asset allocation. Closely tied to diversification, asset allocation involves dividing your investments among various asset categories such as stocks, bonds, real estate, and cash. Your allocation should align with your risk tolerance and investment timeline, balancing potential returns and the risk of losses. Utilizing stop-loss orders. Stop-loss orders are valuable tools that allow you to set a specific price at which your stocks will be automatically sold, preventing significant losses. This practical approach helps limit your potential downside without the need for constant monitoring of your stocks. As markets change, it is crucial to regularly review and rebalance your investment portfolio. This will ensure that your investments match your risk tolerance and objectives. This may involve selling off high-risk assets or acquiring more of those that align with your long-term goals. Understanding and accepting stock market volatility is key. Knowing that your investments will fluctuate lets you stay calm during market downturns and avoid making hasty decisions based on short-term changes. Managing risk involves acknowledging and controlling it, not eliminating it entirely. By implementing these strategies, you can confidently work towards your financial goals. With these tools in place, you'll be better equipped to navigate the unpredictable nature of the stock market. Now that you have learned how to manage risks, it's important to determine how much of your finances should be allocated to investments. In Chapter 5, we will explore how to decide on the right amount to invest based on your financial circumstances and goals. Chapter 5. Determining your investment allocation. Deciding the appropriate portion of your savings to invest in the stock market is a critical choice that relies on your financial circumstances, objectives, and risk tolerance. This chapter will assist you in evaluating your finances to make a well-rounded and strategic investment decision. Evaluate your financial well-being. Before commencing investments, it is crucial to have a clear understanding of your financial health. Ensure that your basic needs are met, you have an emergency fund for unforeseen expenses, and you are free from high-interest debts. These measures create a safety net that enables you to invest more confidently. Define your financial objectives. Are you investing for long-term goals such as retirement or buying a home, or are you seeking faster returns to finance a short-term goal? Your investment timeline impacts the amount you should invest and the types of assets you should consider. Assess your risk tolerance. How much market fluctuation can you handle? If a significant decline in your investment's value will cause you excessive stress or financial difficulties, you may prefer a more conservative approach. Conversely, if you have a longer investment horizon and a higher risk tolerance, you might opt to allocate more to stocks. The 100 Rule. One common investing guideline is to subtract your age from 100 to determine the percentage of your portfolio that should be allocated to stocks, while the remaining portion should be in more secure investments like bonds. For example, if you are 30 years old, you could consider having 70% of your assets in stocks. Remember, this is just a general rule and should be adjusted according to your individual situation and risk tolerance. Systematic investment plans. Another strategy is setting up a systematic investment plan, where you invest a fixed amount into the stock market at regular intervals. This approach, known as dollar-cost averaging, can help mitigate the impact of market volatility by spreading out your investments over time. By taking these factors into account, you can determine an investment level that suits your financial circumstances and contributes to your long-term financial stability. 1. After determining your investment level, the next important step is to grasp the market indicators that will help you make wise investment decisions. In Chapter 6, we delve into the essential market indicators that all investors should know to analyze market trends and make informed trading choices. Chapter 6. Understanding market indicators. What do terms like bull market and bear market mean? To navigate the stock market successfully, it's essential to grasp the meaning of various market indicators that reveal the market's health and direction. In this chapter, we will introduce you to some essential indicators that can assist you in making informed investment decisions, enabling you to identify opportune moments to buy or sell. Bull and bear markets. These terms describe the overall trends in the market. A bull market refers to a period when stock prices are rising or expected to rise, indicating investor confidence in economic growth. On the other hand, a bear market is characterized by falling prices and often reflects economic slowdowns or investor pessimism. Market indexes. Indexes such as the Dow Jones Industrial Average, S&P 500, and Nasdaq Composite provide market performance and sentiment snapshots. These indexes track the performance of a selection of stocks to give an overall indication of market trends. Volume. This indicator reveals the total number of shares traded within a specific time frame. High volume often indicates significant interest in a stock, whether it be buying or selling, which can serve as a signal for potential price movements. Moving averages. A moving average is a technique that smooths out price data, creating a continuous line that helps determine the trend's direction. For instance, a 50-day moving average represents the average closing price over the past 50 days. Relative Strength Index. RSI serves as a momentum oscillator, measuring the speed and change of price movements. It can indicate if a stock is overbought, typically above 70, or oversold below 30, potentially signaling a reversal. Moving average convergence divergence. This tool is utilized to identify changes in a stock's price trend, including its strength, direction, momentum, and duration. Understanding these indicators not only aids in making informed decisions, but also enhances your ability to predict future movements, manage risks, and identify opportunities. However, effectively utilizing these indicators requires precise timing, a crucial aspect of investing. In Chapter 7, we will delve into the art of timing your investments, discussing the appropriate moments to buy or sell stocks based on market conditions and personal investment strategies. Chapter 7. Mastering the timing of your investments. When should you make your move in the stock market? Timing your investments can be a challenging task in the world of finance. While it's impossible to predict market movements with absolute certainty, there are techniques you can utilize to make more informed choices about when to buy or sell stocks. This chapter explores these techniques and emphasizes the significance of timing in maximizing your investment returns. Understanding market cycles. Being aware of the different phases of market cycles can help you anticipate potential shifts in the market. Typically, markets go through periods of highs and lows. By recognizing these patterns, you can better time your entry and exit points. Analyzing economic indicators. Economic reports, such as GDP growth rates, unemployment rates, and consumer confidence indices, can offer valuable insights into the economic landscape and its impact on stock prices. A robust economy generally supports higher stock prices, while a weak economy can lead to market declines. Utilizing technical analysis. As mentioned in previous chapters, employing technical analysis tools like trend lines, support and resistance levels, and chart patterns can assist in identifying potential opportunities to buy or sell stocks. These tools enable you to visually assess market trends and make more strategic decisions based on past price movements. Embracing dollar cost averaging. If timing the market feels too overwhelming or risky, consider adopting the dollar cost averaging approach. This strategy involves regularly investing a fixed amount of money, regardless of the stock price, which can help mitigate the risk of investing a large sum at an unfavorable time. Investing with your emotions can often lead to poor choices in the market. It's essential to stay focused and stick to a well-planned investment strategy to avoid the pitfalls of emotional investing. While there's no foolproof method for success, understanding these principles can greatly improve your ability to make smart investment decisions. By combining market analysis with your personal financial goals, you'll increase your chances of achieving positive outcomes. Once you've mastered the art of timing your investments, the next step is to ensure the safety of your financial assets. Chapter 8 will delve into strategies for protecting your portfolio from fraud, theft, and unnecessary risks. Chapter 8. Protecting your investments. How can you guarantee the safety of your investments? Investing in the stock market is a great way to increase your wealth, but it's essential to make sure that your investments are shielded from potential risks such as fraud, cyber threats, and market volatility. This chapter offers practical tips to help you safeguard your financial assets. Select trustworthy brokerages. The key to securing your investments is to partner with a reputable brokerage firm. These firms are regulated by financial authorities and provide protection through programs like the Securities Investor Protection Corporation in the U.S., which can insure your investments up to a certain limit in case the brokerage goes under. Robust online security measures. In today's digital world, it's crucial to ensure the security of your online brokerage account. Use strong, unique passwords, activate two-factor authentication, and regularly check your accounts for any unauthorized activities. Diversification. As mentioned earlier, diversification is not only a risk management strategy, but also a way to shield your portfolio from the impact of a single failing investment or sector. A well-diversified portfolio can handle market fluctuations better than one that is heavily focused on one area. Understanding and utilizing risk management tools. Take advantage of risk management tools like stop-loss orders, which automatically sell your assets at a predetermined price. This helps minimize losses during a market downturn. Stay updated. Stay informed about the latest news and trends in the financial markets. Also, keep an eye on any regulatory changes that could impact your investments. Being well informed will make you a more secure investor. Regularly review and adjust. Regularly review your investment portfolio and make necessary adjustments based on your financial goals and market conditions. This will help you stay aligned with your risk tolerance and investment strategy. Investing securely requires both vigilance and knowledge. By implementing these strategies, you can protect your investments and feel more confident in your financial decisions. Now that you've safeguarded your investments, it's time to focus on another crucial aspect of successful investing: setting and achieving specific financial goals. In Chapter 9, we will explore how to establish clear investment goals that align with your long-term financial plans, ensuring that your investment activities support your overall economic well-being. Chapter 9. Establishing investment objectives. What are your financial aspirations when it comes to investing? Successful investing goes beyond simply selecting the right stocks or safeguarding your assets. It primarily revolves around accomplishing your personal financial goals. This chapter concentrates on how to establish clear, actionable investment objectives that can steer your financial choices and assist you in achieving your long-term dreams. Define your goals. Begin by clarifying what you aim to accomplish through your investments. Are you saving for retirement, a down payment on a house, your children's education, or building an emergency fund? Your goals can be short-term or long-term, but they should be specific, measurable, and in line with your overall financial plan. Assess your time frame. Your investment strategy should reflect the amount of time you have to achieve your goals. Longer time frames generally allow for more aggressive investments in stocks, as you have the opportunity to recover from any market downturns. Shorter time frames require more conservative approaches, such as bonds or stable value funds, to protect your capital. Evaluate your risk tolerance. Understanding your comfort level with risk is crucial when setting goals that won't cause excessive stress or lead to impulsive financial decisions. Your risk tolerance will impact how you allocate your assets and may change over time as your financial situation evolves. Develop a strategic plan. Having clear objectives, a specific time frame, and a grasp of your risk tolerance will enable you to create a strategic investment blueprint. This blueprint should detail how you plan to distribute your assets among different investment categories and industries to maximize your returns while minimizing risks. Regular review and adjustments. Investment objectives are not fixed. They should be assessed regularly and modified in response to alterations in your financial circumstances, market conditions, or personal priorities. This adaptability is crucial for maintaining a relevant and efficient investment approach. Apply SMART criteria. Make sure your investment objectives are specific, measurable, achievable, relevant, and time-bound. This approach helps establish clarity and achievability in your financial planning. Establishing well-thought-out and clearly defined investment objectives is the foundation of successful investing. By aligning your investment actions with your personal financial goals, you guarantee that each investment choice brings you closer to your desired financial future. Once you have set your objectives, understanding how broader economic cycles can impact your investments becomes essential. In Chapter 10, we will delve into how economic cycles influence the stock market and how you can adapt your investment approach to take advantage of these shifts or shield yourself from potential downturns. Chapter 10. The impact of economic cycles on your investment strategy. Understanding how economic cycles can affect the stock market is essential for making smart investment choices. In this chapter, we will explore the different phases of economic cycles and how they can influence market performance. By adjusting your investment strategy accordingly, you can optimize your returns and minimize risks. Phases of economic cycles. Economic cycles consist of four main phases: expansion, peak, contraction, and trough. During the expansion phase, economic activity increases, businesses thrive, and stock prices generally go up. At the peak, economic growth slows down, which can lead to stocks being overvalued. The contraction phase, also known as a recession, involves a decrease in economic activity and often results in lower stock prices. Finally, the trough marks the lowest point of economic activity, after which recovery begins. Sector performance. Different sectors of the economy react differently to each phase of the economic cycle. For instance, consumer staples and utilities tend to remain stable during economic downturns, while sectors like technology and consumer discretionary can perform exceptionally well during periods of expansion. Portfolio adjustment. By gaining insight into the current state of the economy, you can make necessary adjustments to your investment portfolio in order to take advantage of sector performances. This could involve reallocating more of your investments into defensive stocks during a contraction or increasing your stake in growth-oriented stocks during an expansion. Taking the long-term view. While understanding economic cycles is valuable, maintaining a long-term perspective on investments is crucial. Making frequent adjustments in response to short-term economic changes can result in higher transaction costs and tax implications. Utilizing leading indicators. Investors can utilize leading indicators such as the Purchasing Managers' Index, jobless claims, and building permits to anticipate shifts in economic cycles. These indicators can offer early indications of economic expansion or contraction. Aligning your investment strategy with the broader economic landscape can enhance your ability to navigate market volatility and make more strategic investment decisions. Furthermore, apart from comprehending economic cycles and their consequences, it is beneficial to venture into opportunities outside of your local markets. In Chapter 11, we will thoroughly examine the potential advantages and risks associated with investing in international stock markets. This will enable you to diversify your portfolio and potentially capitalize on economies that are experiencing rapid growth. Chapter 11. Exploring international markets. If you are thinking about investing outside your home country, diversifying your investment portfolio by adding international stocks can bring significant advantages, such as access to faster-growing economies, risk diversification, and exposure to new opportunities. This chapter delves into the benefits and challenges of investing in international markets and offers advice on how to navigate this dynamic aspect of portfolio management. Benefits of international investing. Investing internationally can improve portfolio diversification and lower risk. Different markets and regions often move independently. When domestic markets are struggling, international markets may be thriving. Moreover, specific sectors and industries may be more developed or promising in other countries. Risks and considerations. Although the potential rewards are attractive, international investing carries its own risks. These include currency fluctuations that can impact returns, political and economic instability, regulatory differences, and challenges in obtaining reliable information about foreign investments. How to invest in international markets. There are various ways to invest in international markets. Purchasing stocks in foreign companies on their local exchanges, which may necessitate a brokerage account that supports international trading. Mutual funds and ETFs offer a convenient way to access international markets. By investing in a range of stocks from different countries, these funds provide instant diversification. American depository receipts make it easy to invest in foreign companies by enabling you to buy shares of international companies on U.S. stock exchanges. This means you can purchase shares in U.S. dollars and receive dividends in U.S. dollars. Buy dollars. When adding international exposure to your portfolio, it's important to consider your overall investment strategy, risk tolerance, and the economic outlook of the regions you're investing in. It's also crucial to be mindful of the proportion of your portfolio allocated to international investments. Successful international investing requires an understanding of the cultural, economic, and political contexts of the markets you're investing in. These factors can impact consumer behavior, government stability, and ultimately the performance of your investments. While international investing presents numerous opportunities, it requires careful planning and consideration. It can expand your investment horizon and potentially improve returns by diversifying risks. Once you have established your global investment strategy, it's time to refine your investing skills further. In Chapter 12, we will explore advanced investment strategies that can help experienced investors fine-tune their portfolios and capitalize on specific market conditions. Chapter 12. Advanced Investment Strategies. Ready to elevate your investment game? Once you've mastered the basics and feel confident in traditional investment methods, delving into advanced strategies can boost your portfolio's potential returns and help you navigate risks more effectively. This chapter illuminates some sophisticated techniques that seasoned investors employ to seize specific market opportunities and adapt to changing conditions. Options trading. Options enable you to speculate on stock price movements without owning the actual shares. They offer high leverage, potentially yielding substantial returns from a modest initial investment. However, they come with significant risks and demand a solid grasp of the underlying principles. Short selling. This tactic entails borrowing shares of a stock you anticipate will decline in value, selling them at the current market price, and repurchasing them later at a lower price. Short selling can be lucrative in bear markets, but carries the risk of substantial losses if the market turns against you. Leveraged ETFs. Leveraged exchange-traded funds utilize financial derivatives and debt to magnify the returns of an underlying index. While they can deliver significant gains in favorable market conditions, they also pose the risk of substantial losses, particularly in volatile markets. Hedging is a technique for minimizing risk by taking a counterbalancing position in a related security, such as options or futures. For instance, if you have a significant stock holding, you may choose to purchase options as insurance against a substantial drop in the stock price. Arbitrage, on the other hand, involves capitalizing on price discrepancies of the same asset in different markets. For example, if a stock is listed on two separate exchanges with varying prices, an investor could buy the stock on the lower exchange and sell it on the higher exchange, profiting from the difference in prices. Both of these strategies require a deep understanding of the markets, precise timing, and effective risk management. They are not suitable for everyone and should be approached with caution. As you continue to refine your investment strategies and become more comfortable with advanced techniques, it becomes increasingly crucial to prioritize ongoing education and stay updated on new developments and strategies in the world of investing. In Chapter 13, we will delve into the significance of continuous education in investing and provide valuable resources to help you stay ahead in the fast-paced realm of finance. Chapter 13. The importance of continuous education in investing. As an investor, it is crucial to continuously grow and expand your knowledge in order to achieve success. The world of finance is constantly evolving, with new developments and technologies emerging all the time. By staying informed and continuously learning, you can enhance your investment skills and stay ahead in the fast-paced world of finance. This chapter emphasizes the significance of ongoing education in investing and provides valuable resources to help you stay updated. Formal education. Consider enrolling in finance-related courses, either online or at educational institutions. Courses on economics, business, finance, and market analysis can provide you with deep insights and a solid foundation in investment principles. Books and publications. Maintain a reading list of foundational texts and current publications in the field of investing. Renowned authors like Benjamin Graham, Peter Lynch, and Warren Buffett offer timeless advice, while contemporary finance books and periodicals can provide insights into current trends and strategies. Seminars and workshops. Attending seminars and workshops led by industry experts can offer valuable learning opportunities. These events often focus on specific investment strategies and market outlooks, and they also provide networking opportunities that can be beneficial for your investment journey. Online resources. Take advantage of the vast amount of information available on the internet. Financial news websites, investment blogs, podcasts, and webinars are all great sources for staying updated on market trends, economic reports, and expert opinions. Investment clubs. Consider joining an investment club to connect with like-minded individuals and exchange knowledge and strategies. Engaging in discussions and collaborating with fellow investors can provide valuable insights and reinforce your learning through practical application. Professional certifications. If you're looking to elevate your expertise, professional certifications such as the Chartered Financial Analyst or Certified Financial Planner can enhance your credibility and expand your knowledge. The key to continuous education in investing lies in maintaining curiosity and embracing the role of a perpetual student of the market. By adopting a mindset of ongoing learning, you can adapt to changes, avoid common pitfalls, and make more informed investment decisions. Equipped with an advanced understanding and a commitment to lifelong learning, the final step is to consolidate your knowledge and develop a solid investment strategy for the future. In Chapter 14, we will delve into how to review and plan your investment journey, ensuring that your strategies align with your long-term financial goals. Chapter 14. Evaluating and mapping out your investment journey. How do you evaluate your investment performance and plan your next steps? As you come to the end of this introductory guide to investing, it's crucial to assess your progress and plan effectively for the future. This final chapter focuses on the important practices of reviewing your investment performance and strategizing for ongoing growth and stability in your portfolio. Regular portfolio assessments. Establish a routine for regularly evaluating your investment's performance in relation to your initial goals and the broader market benchmarks. This involves analyzing not just the returns but also how well your portfolio aligns with your risk tolerance and time horizon. Performance metrics. Utilize key performance indicators like return on investment (ROI), annualized returns, and comparison against relevant indexes to gauge the success of your investments. There are tools and software available to assist you in effectively tracking these metrics. Adjusting strategies. Based on your assessment, you may find it necessary to rebalance your portfolio to realign with your target asset allocation or adjust your strategy in response to changes in your personal circumstances or economic conditions. Rebalancing helps manage risk and maintain alignment with your goals. Setting new goals. As your financial situation or lifestyle changes, your goals may also evolve. Regularly updating your investment objectives ensures that your strategies continue to reflect your current needs and aspirations. Continued education. As we discussed earlier, make a commitment to continuous learning. It's important to stay informed about new investment strategies, market changes, and financial tools. This will help you stay agile and proactive in managing your investments. Seeking professional advice. Consider regularly contacting financial advisors or investment professionals. Their expertise can provide valuable insights, especially when you're faced with complex decisions or significant changes to your investment approach. By maintaining a disciplined approach to reviewing and planning your investment journey, you can ensure that your investment portfolio remains strong and responsive to both opportunities and challenges. In conclusion, this book has given you the fundamental knowledge and tools to start your journey in stock market investing. As you move forward, remember that becoming a confident investor requires continuous learning, thoughtful decision-making, and an adaptable mindset. Embrace these practices, and you'll be well on your way to achieving your financial goals and building a prosperous future. Thank you for listening. Enhance your learning journey by subscribing to our channel today. Each video we create is designed to challenge, inspire, and enlighten you. By subscribing, you'll stay up to date with the latest content and support our mission to make learning accessible and engaging. Your feedback helps us tailor our content to better serve you. Join the conversation below and let's learn and grow together. Let's push the boundaries of what we can achieve together. Take care and thrive.